Watch a skyscraper rise from a dirt lot. The physical reality of that concrete and steel is obvious. But while the physical asset remains entirely static, the financial reality of that exact same structure is completely fluid. In a complex real estate development, monitoring the cash flowing in and out of the project bank accounts is an incomplete metric for success. Relying on cash flow alone obscures actual profitability and liabilities. The core axiom of real estate accounting dictates that the operational intent of a building completely overrides its physical form. To map that physical concrete into an accurate financial reality, the industry relies on IFRS. The International Financial Reporting Standards form a globally recognized accounting framework that establishes exactly how different types of business transactions must be reported. Treating physical construction and financial reporting as siloed operations guarantees non-compliant financial statements and distorted asset valuations. To understand how this translation works, we will track a theoretical multi-phase mixed-use development from a dirt plot to a fully occupied skyscraper. We will evaluate the exact same structural design under 3 distinct operational intents. Our tower will contain residential off-plan sales in the middle, retail leasing at the base, and a corporate headquarters at the top. Every poured foundation, every completed floor, and signed lease in this tower triggers a specific financial event that operations and finance teams must capture simultaneously. The initial phase of any major real estate project involves acquiring the raw land and beginning the physical earthwork and construction. At this stage, accountants apply a strict rule. They must separate the costs that build long-term asset value from the costs that represent immediate operational burn. Direct costs, like land, steel, and labor, are capitalized. They are recorded on the balance sheet as assets, generating future economic benefits. Conversely, costs like marketing and administrative overhead are immediately expensed. They're charged to the income statement, reflecting the immediate cost of doing business. The stakes here are high. If a developer misclassifies a capitalized construction cost as an operating expense, they artificially lower current profit margins and severely distort long-term viability. Capitalized costs build the financial foundation of the asset, while expensed costs capture the immediate friction of running the development. We now shift our focus to the middle floors of our theoretical tower, which the developer has designated as off-plan residential apartments. Buyers pay a 20% deposit upfront to secure their units, generating a massive influx of cash, but the physical building is still years away from completion. This chart compares cash collected against recognized revenue. The cash line is high, but the revenue curve is flat. That is because the IFRS 15 standard strictly prohibits recognizing that collected cash as immediate revenue. IFRS 15 dictates revenue from customer contracts is recognized only as physical performance obligations are satisfied. This percentage of completion method is for off-plan sales. If the foundation and framing represent 40, under IFRS 15, an accurate income statement cannot exist without granular, real-time data from the physical construction site. Fast forward to the final completion of the physical structure, where the asset transitions into full tenant occupancy and daily operations. Once operational, the accounting treatment of the building splits permanently. The exact same concrete and glass are valued differently based on how each specific floor is utilized. Look at the bottom floors of the tower, which operate as a retail mall leased entirely to external commercial tenants. Held for rental income, this space is investment property under IAS 40. Using the fair value model, the retail floor's balance sheet value fluctuates with market trends. This introduces earnings volatility, but maximizes transparency for investors tracking the asset's current worth. Now, shift focus to the top floor of the tower, which the developer utilizes as their own corporate headquarters. This owner-occupied space is property, plants, and equipment under IAS 16, outlining rules for operational assets. PPE cannot use the fair value model. It must be measured at historical cost and systematically depreciated over its useful life to match physical wear and tear. Identical concrete floors generate completely different income statement realities, dictated entirely by whether they house paying tenants or corporate employees. We must now re-examine this completed tower as a unified financial entity rather than isolated floors. The separate accounting realities of IFRS 15, IAS 40, and IAS 16 must aggregate perfectly into a single organizational financial statement. Managing these parallel, highly complex data streams requires integrated ERP systems. Enterprise resource planning systems are centralized software platforms that connect operational data directly to financial reporting. Consider a failure scenario. The operational managers decide to change a floor's use from the corporate headquarters to a leased retail space, but they fail to notify the finance team. That single communication failure instantly invalidates the entire depreciation schedule and renders the organization's asset valuation non-compliant with international standards. Scaling this up from a single tower to the macro-level complexity of the global real estate ecosystem reveals the true scale of the challenge. Physical operations and financial reporting are not sequential steps. They are concurrent, deeply interdependent loops. This requires strict role differentiation, where project and facility managers actively act as physical progress auditors for the finance team. True financial transparency in real estate is achieved only when the actions on the ground are accurately translated into the standardized global language of IFRS.